Hello, everyone. My name's Neil Bawa. I'm a self-confessed geek. I am a nerd. I nerd out on understanding and using technology solutions that solve real problems. And my companies, both Grow Capitus and YouGrow, we've got $1 billion real estate portfolio. So luckily, I get to run hundreds of experiments and experiments where Anna and I use technology to build and optimize real estate. So we think that we're good candidates to present a webinar that talks about this phenomenon called Proptech. And what does this phenomenon mean, not just for the present, but the future of real estate, right? And what does it mean for you, for real estate investor profits? So my job today is to tell you about PropTech as a phenomenon, but also to introduce you to dozens of companies that are solving real estate problems. Now, I am not representing any of these companies. I have no axe to grind. In fact, I'm a customer of many of these companies. They don't even give me a discount, right? My goal is that when you leave the webinar today, hopefully you've written down some of these companies because they solve a problem that you have as an investor or a landlord, right? So if I can achieve that for some of you, that would be a great result. But if not, at least you can fully understand the nature of this prop tech disruption that we're going through. And for those of you that still don't know me, I am a quirky and opinionated data scientist and technologist. I buy and build large projects with Anna's help. She does all the work. I do all the rah-rah. Multifamily, student housing, industrial, self-storage. These are some of our favorite watering holes. So portfolio is 30 properties, 10 states, about almost $1 billion. That's my day job. What I like doing the most is doing this. I like to teach, to explode myths, and to talk about things that most people may not think about. So I hope you have as much fun with this as I am going to have. You are welcome to bring on the snarky remarks. This is not a sarcasm-free zone, so have at it. The funniest comments will actually get a special shout out at the end from Anna or from me. So get ready to share your opinions. A little bit about
Don't you want to
our
turn off
company.
video?
Yeah, that perfect timing. Thank you. So I don't want to block the screen. So a little bit about our company, Grow Capitus. This is a sampling of our portfolio. So what you're seeing on the screen is a little less than half of the portfolio. On the left in green are past and present multifamily value adds, and we've been exiting them at 20 to 40% annualized returns. And our first two 50+% annualized return exits happened this year with a third blockbuster exit about to happen. Or did it already happen this week? I think it just happened last week. All right. So in orange on the top right, these are new construction complexes that we're building or have built. All four of the ones shown here have either been delivered or been leased up or are delivering right now. The grid, for example, has 17% cash flow. Coyote Creek is around 8% and growing fast. Now, on the bottom right, in blue, these are the diversification projects that you, our investors, wanted, self-storage and industrial warehouses. Our self-storage project is the one that exited earlier this week at over a 50% annualized return. So we're very excited about that. The other half of our portfolio, it's in a new asset class. It's called build to rent. And if you don't know build to rent today, it's the same as not knowing Bitcoin in 2010. Simply put, BTR is the new Class A apartment complex, and it is the largest, most powerful, most profitable opportunity that exists anywhere in real estate today. Now, the second one from the left in the top row, that's Botanica Oak Hills, is actually delivering at this point of time. So we just came back from from San Antonio and Austin to check it out. So super excited. The projects in the top row are older built-to-rent projects. The bottom row are the bigger, more powerful projects that we've been dreaming about for years. And finally, now we get to build them. So all six of those are in some stage of construction with a completion value of close to 500 million. Here's our track record. As you can see, over 7 exits. So we've delivered more than double the results that we projected to investors many years ago. I think anyone in a rising market can do this on a few projects, but on 7 to achieve these kinds of results. So our team of nearly 30 people works tirelessly to achieve these results. And yes, track record is critical, but what's more important to us is that our 800 plus investors like us and they like our work. For example, Sarah, she's invested in 8 deals. She's had 3 terrific exits. She's also invested in a new construction project that is now expected to outperform. So she talks about how we outperform other syndicates, how we look for better ways to do things. So take a quick look. And Chong is an investor in 10 projects with us. And here she talks about an exit where we went the extra mile by building an additional 29-unit building to juice the returns. Take a quick look. All right, I'm done with the Grow Capitalist intro and the obligatory rah-rah thump my chest section. So it's content time, but before we get to the content, here's the really boring stuff that my lawyer forces on you. This is an educational webinar. It doesn't squeeze out the risk in real estate investing. My recommendations are not magic, they are personal opinions. Do your own due diligence, consult professionals, and understand that even if you do all of those things, you could still lose money. Bottom line, real estate and stocks are at risk investments. And today I'm going to be talking more about stocks than real estate. So, and feel free to type in your questions. I love questions. I'll take questions no matter how far from the content they are. I'm happy to take them. We'll be, by the way, we'll also be sending out a recording of this event tomorrow in case you need to jump out. All right.
Questions in the Q&A box, please,
Q&A
not
box.
the chat box.
Not the chat box. There we go. Thank you. Now, the best way to introduce a new topic is through a definition. Note, I'm not just going to define Proptech, which is short for property technology, but also FinTech, which is short for financial technology. Why? Because FinTech's part of the Proptech story, so it's very important to also define it. Now, let's start with FinTech first, right? FinTech companies, they scale and automate the flow of money using technology, and they have far lower overhead, less infrastructure than traditional finance companies like banks, right? Their office is a website, their marketing channels are internet, their models mostly self-service, so usually through apps, right? So clicks instead of paper. Three very famous fintech companies that are not on this page are PayPal, Square, and Venmo. All three make it easier to move money around. But note that on the screen, I didn't use PayPal or Venmo in my examples. Fintech's a big umbrella, thousands of tech companies, right? All three of my examples are fintech companies that flow money into real estate. So CrowdStreet, Cadre, and Fundrise are fintech companies because they raise money from investors for real estate investment. But they're also prop tech companies. Why? Because they take that money and they pour it into real estate. And that makes them prop techs. So let's define this term, prop tech. Well, a prop tech company focuses on scaling the construction or the management or the investment of real estate using technology. They are disrupting the old-fashioned ways in which real estate is built, managed, bought, or sold. The three examples that I already gave you are prop techs because they're changing the way real estate is invested, right? Now let me give you a couple other examples, right? Who hasn't heard of Zillow? Zillow helps us buy and sell and manage real estate. Compass on the screen is similar to Zillow. They are a tech-enabled brokerage. Opendoor is quite different. They're basically an iBuyer. They allow people to sell their properties without an agent in minutes. And how do they do that? You provide some information or video of the property, and boom, you receive an initial offer in minutes, which becomes a final offer after an Opendoor agent actually walks through the house. Super convenient, right? And then there's Roofstock. Roofstock also helps you sell your property, but their real neat trick is that they allow you to invest in rental real estate for 5K, 5,000, right? They find and they buy and they manage the real estate, and you can invest in 5K chunks in various portfolios of single family homes and then get cash flow. For example, last week they had a portfolio of 8 properties in and around Atlanta and Indianapolis that you as investors can invest in 5K chunks and you can get cash flow without work. Now, the cash flow is low, but think of it as competing with stocks, which basically offer no cash flow at all. Now, for example, in the last slide, I discuss Roofstock, right? So remember, they help people buy and sell real estate, but you can also invest in single family portfolios that they find and buy and manage in $5,000 chunks. And very recently, SoftBank invested a stunning $365 million in Roofstock. With this investment, Roofstock went from a stunning $600 million to a crazy $1.94 billion in value. Now I know there's at least 178 of you thinking, is that 1.94 billion before the real estate crash? Yes. Roofstock's probably worth a lot less, but they haven't gone public just yet, so I can't tell exactly what that number is. If I had to guess, I'd say it's about half. Still worth $1 billion. Why? Because single family real estate is now becoming an enormous asset class, not just for mom and pop investors, which it has been for 100 years, but for institutional investors. Everyone wants in, not just SoftBank. My wife's a school teacher in Hayward Unified School District. Their pension fund is investing in real estate. BlackRock and Blackstone are two smart, very investing titans. Both of them are investing in single family portfolios. And so a company like Roofstock, which is on the buy side, the sell side, and the management side for single family portfolios, is just hot, hot, hot. And the end result of rising rents and the rising prices and huge interest from institutional buyers in housing and BTR is that companies in this space are getting great valuations. Yes, they have fallen 40 or 50% in the last 6 months, but overall, these numbers are pretty darn crazy. Our next section, by the way, we're going to get deeper into some of these different companies. And you cannot imagine just how much money is flowing into Proptech. In 2021, an absolutely mind-boggling $32 billion was invested into these property technology companies. 32 billion, right? It's probably less this year. I'm guessing it's about $20 billion. But in a single year, $20 billion. Half of that just went to prop tech companies focusing on residential or single family market. And venture capital funds have also increased by 28%, as you can see on the bottom left there, since 2020, right? We know that the market's down, right? Things were getting very bubbly, very frothy. So it's actually a nice thing for you because you're learning about prop tech now when values have declined a great deal. Because weak companies are dying, strong ones are prospering, but everything is available today either at a discount, a very big discount, or a just batshit crazy discount. So that's pretty awesome. It's a great time to learn more about prop tech. Now, moving on, right? So I know 2022 looks weaker by comparison, but I can tell you 2022 is still going to very easily beat 2020. That bar that you see for 2020 might even end up beating 2019. I'm looking at the numbers now. Now, here's a really nice chart. It shows off all the different segments of prop techs, right? We sliced and diced. So on the left, you see companies working on every aspect of development of homes. Right? I like Blockable. Where's Blockable? Right here. Okay, Blockable, right? So as an investor, you might want to follow this particular company. They're building a modular home product in their factory, just like my Casada project in Austin, except Blockable has stacking technology. Wow. So guess what they can do? They can build stackable multifamily really, really fast using cranes. Another one that's interesting to watch is in the middle section here. You see this? Divi, right? And feel free, by the way, to grab a pen and write these down, right? Blockable, Divi. So Divi's created a rent to own model where renters can become eligible to own the property they're renting in as little as 3 years. So they've got a huge wait list of people. Now, on the right, in the asset utilization category, everyone knows Airbnb, right? But look under Airbnb and you're going to see Star City. Star City. This company is now called Common, and they're doing for co-living what Airbnb does for vacations. So they've got co-living properties in a dozen cities, and they're turning the long-term rental models totally on its head. Now, I could literally spend an hour on this slide, but let me just say this. This slide has at least, 10 billion-dollar companies. As an investor, with a little bit of research, you can figure out how to use the coattails of these companies to make money in real estate, especially today where everything is available at shocking discounts. Now, let's go back a little bit before the crash. Let's look at some recent deal examples. This is pre-crash, right? Picasso. This is my absolute favorite because I'm likely to become a client of theirs. Guess what this PropTech does? They buy luxury single-family homes for an average of 6 million bucks. Yes, McMansions. Then they sell 8 fractional shares to rich people. These rich people then get to live in Picasso homes up to 44 days a year. These buyers, they can't make any money from their fractional shares, except long-term appreciation. So there's no renting, there's no Airbnb. It's just a more efficient way of buying fractional luxury real estate for rich people. Picasso, they're very smart. They charge a 12% one-time fee to the buyer. So up front, they sell a $6 million property, they make $720,000. Good deal, right? These guys went from launch to unicorn status in 5 months and at an astonishing $1.5 billion valuation. I'm guessing they're probably worth half of that. I think this is a great company to invest in, right? Many of you might be skeptical about Picasso. I mean, Neil, come on, where's the value here? So they buy mansions and they sell shares to rich people? Yes, but imagine buying $1 billion worth of mansions a year and then making a 12% fee on them and then charging ongoing management fee to manage them for the 8 owners. The rich people love it because they get to own a $6 million home for 800,000. And what's happening is that the rich guy, instead of buying one $6 million second home, they're buying 8 shares in 8 different Picasso homes. So the dude now owns 8 mansions. This is disruptive. It's not a bad deal if you're rich. Trust me, I'm looking at it. I want to buy one of these shares, right? I don't want any hassle. 44 days is plenty for me. I love my home in the San Francisco Bay Area, but it gets really cold in December, right? That's the value here, right? And by the way, they're selling crazy numbers of property. Go to PACASO. I see a brand new property every second day on their website. So you can imagine this is a very sticky way to own McMansions. Investors love it. I think this company would eventually be worth over 10 billion bucks because I think their concept is very scalable and they can make money from day one. Now, in the middle, Service Titan. This is a software platform, right? It connects landlords, property managers, and investors to tradesmen, to contractors. And these contractors can now offer financing to their customers through Service Titan. They can provide estimates, they can get marketing services to find clients, they can even monitor job costs, all in one software for contractors. This allows contractors to grow much faster than they ever would. How many people using this service? 100,000 contractor clients already. That's pretty amazing, right? So pre-crash, 9.5 billion. I think they went public, so you might want to look them up. I haven't looked them up for this webinar. I wouldn't be surprised if they're at 2 or 3 billion dollars. So the Proptech market got hammered, which means both the good companies and the bad companies got hammered just as much. Great opportunities. And it's not just investment numbers that are high. The last slide I was showing you investment numbers, right? A record number of prop tech companies are now exiting, and they're exiting at crazy valuations, right? Obviously, this is pre-crash. These are just 4 of them. 3 of these exits were over $1 billion. The red one on the left, Procore, was an initial public offering or IPO, and then the other 3 went public by doing something known as a SPAC entity merger. Now, as you can see, there's a lot of diversity, right? On the left, PropTech, construction companies top, in the industry's top software. So if you ask anybody in the construction industry, what's their top software? It's Procore, right? When I build beautiful built-to-rent properties, my team is using Procore to manage thousands of tasks and dozens of contractors. SmartRent in blue, they've got pretty cool technology that allows property managers to show a property to a tenant or a buyer remotely. So it's very slick technology. It uses smartphones and driver licenses to make sure that the right person is entering the property and then basically gives them remote access. So this allows a property manager to do a tour at 7 a.m. on Sunday or 8 p.m. on Saturday. It extends efficiency, it rents properties faster, and they were able to go public for 2.2 billion. I wonder how many of you are checking on their price today. I'm guessing under $1 billion. Bottom line, if the business model is strong, the investment is there, the exits are there for both PropTech and FinTech company, and anybody that's gone public recently is at least half off, some are 75% off. There's a lot of interest. There's a lot of liquidity in the public markets still, despite the crash, and there's a lot of bargains. Before the crash, PropTech was the second hottest vertical in venture capital, with blockchain being the first. Between 2020 and 2021, nearly 400 unicorn companies joined the $1 billion club. And this is overall, not just PropTech. 400 in 1 year. That's nuts, right? As traditional industries are disrupted, more and more money is flowing in to tech-driven disruptive models. And yes, their valuations have fallen. So what? You haven't invested yet. So good for you, right? And since real estate is the largest asset class in the world, there's a lot of focus today on real estate disruption. And the US is taking the lead. 50% of unicorns today are in the US. So we're still the cutting edge of technology. And there's more public listings and more SPAC exits for bigger deals in general, not just in Proptechs, but just everywhere, right? On the left, you see IPO exits. See how big the bars are in 2020 and 2021. I think 2022 will be maybe half that. Still a lot bigger than 2020. On the right, you see the SPAC exits. This one might fall a lot more. It might go from 11 to like 2 or 3. But again, these are massive numbers. So there's a lot of opportunity. And it's not just venture capital. Private equity is putting in huge dollars into these tech companies. And private equity is also buying these companies. So on the left side, they're investing. On the right side, they're basically buying these companies. So they're not even going public. Private equity companies are buying them. And companies, and now I'm not talking about private equity companies, I'm talking about companies like Apple or Google. Regular companies are not being left behind. They're using their dollars in the bank to buy these companies like prop tech companies. So look at this difference between 2020 and 2021, right? 250% jump. Even with the correction, it's very clear. Investment sentiment, buyout activity, extremely strong. Now, I want to introduce you to one new, very fast growing prop tech market, and that is health. In a post COVID world, people want to live in healthy homes. And surveys indicate that 76% of renters believe that their homes are harming their health and well being. 66% believe that a healthy home could cut down their medical bills. And 83% are willing to pay more for a healthier home. So there's so much interest from consumers. So a huge number of companies are launching healthy home tech products. But the world leader is a company that I am a client of. No other connection. I'm just a client. It's called Delos, right? I'm a happy customer and I was a customer before COVID. They don't pay me, I don't own stock in them, but boy, this technology is very impressive and can make a lot of money for those of you that are looking at class A rentals, higher end rentals. The margins and premiums that you get from healthy homes, pretty fantastic. What Delos does is they use an iPad-based home wellness intelligence platform. The iPad's installed right inside the front door of the home or rental, and it's constantly monitoring, it's improving air quality, measuring and improving water quality. So they do have filters as well. So they have machines that they install. So there's equipment, not just an iPad. Delos' technology, which is usually installed in the garage, can actually filter out COVID and other harmful particles. Their water filtration can remove chlorine and particulates and even cysts. And their indoor air quality monitors can immediately warn you if you have carbon monoxide or other dangerous gases or particles in the indoor air. Delos, after its founding, they did something smart. They created a collaboration with the Mayo Clinic to study the impact of indoor environments on our health. They created something known as a well living lab, and that led to the well building standard, which led to the creation of the Well Living Institute. And the standards that were produced by the Well Living Institute have now led to 30,000 well projects in 98 countries, 3 billion square feet of living space. When I was vacationing in Dubai, they were advertising a brand new luxury tower. Guess what I noticed? 100% of the units were Delos, and they were leading with the Delos brand and the Well Living standard. Now I know Delos is preparing to go public, so I'm excited to become an investor of theirs. My thinking, these guys, they've got 30,000 projects. They're the world leaders. They set the standards. Given that there are tens of millions of residential and commercial buildings just in Western countries, I think these people have a truckload of room to grow. So I'm not an investment advisor. Do your own research. But this looks interesting, guys. Just one last slide on this particular prop tech. These are just some of the global clients that Delos already has, and I happen to know that Delos is profitable. Hope they don't sue me for saying that. All right. So bottom line is, so far I've been saying good things. It's like Neil, come on, and the stock market crashed, blah 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 blah. Yes, I get that. I get that. I was coming to it at the end because I want to start offering some bargains and start giving you some pointers, right? So obviously there's a huge impact of the stock market crash on prop tech. But and let's review on the carnage, but before that, let's just talk about the crash itself. Not everyone reads the news. Most of you do. Let's start with the middle section, right? So the S&P 500, worst return in 60 years. Treasuries, worst half in over 200 years. Only one stock in 11 in the S&P 500 has gone up. 10 of them have gone down. And of course, Bitcoin, down 60% in the first half of the year. Ouch. I own quite a bit. Looking at sectors on the left, every sector except energy here on the bottom left, right, dropped, including REITs. So you see that right here? This is real estate trusts, right? This is kind of in the middle of the pack because these are still stocks. They're still in the stock market. We haven't seen any drop in real estate, but real estate stocks have dropped. And that should give you a clue to what is happening to Proptech stocks. After all, they are stocks. Now, before we talk about correlation between Proptech and stocks, I do want to interject one slide. I want to talk about correlations between real estate and stocks. Not talking Proptech here, just real estate and stocks, right? I could spend so much time on this slide, but I'm just going to focus on the box that's on the bottom, this box section here. Note that the relationship between stocks and real estate is actually quite complex. Our analysis shows that if the S&P 500 declines 10 to 15%, money surges into real estate. People get freaked out, right? Stock people. And we're seeing that now. On the whole, the real estate market is up this year, especially the single family market, which is obviously the largest component of the real estate market. Now, here's what happens when stocks decline 25 to 30%. Well, then real estate prices start to drop. This happens for a variety of reasons, with layoffs being one reason, but an overall souring of investment sentiment. So obviously the big question is, okay, so Neil, how far are we from this 25% point? And the short answer is, I don't have a freaking clue. Where do I calculate it? If I look at the last 12 months, the S&P 500 is up 12%. If I look since July last year, it's up. It's up. So obviously, we're nowhere near a 25% drop. We're not even at a 0% drop. But if I look since January, we're at minus 22%. So we're getting close to this point, right? But this is a very short amount of time. And this math really requires a full year. Bottom line, if you're looking for what real estate does, firstly, real estate takes a long time to react, right? Everything is delayed. So it takes about a year, right? So we're halfway through a slaughter year. I think by the end of the year, if you start seeing numbers for the S&P 500 that are higher than this 22%, so from Jan 1st to December 31st, then I think you'll start seeing real estate prices drop. I know you guys were going to ask this, so I decided I'm going to stick a slide in there anyway, even though this is not PropTech. But I think the reason I'm mentioning this is if real estate can get affected by stocks, PropTechs are definitely going to get affected, right? And they have been slaughtered. So on the left is Latch. Latch is an amazing company. They're a smart lock company that has great mind share within the multifamily industry, within the office industry. So basically, they're not a smart lock company that's really selling stuff on Amazon. They're basically building ecosystems for offices to get locked, for multifamilies to get locked. They're basically enterprise company, and they went public at $1.5 billion. I think this is a strong company. Valuation today, 181 million. They're down 85%. Now, some of that is because they were overvalued, just like every other prop tech. I don't think they're worth 181 million. WeWork, and I know a lot of you immediately have this bad vibe on WeWork. Yes, they had a crappy CEO. He's gone. They overvalued their company. You don't have to deal with that. It was worth $47 billion before it went public. And when it went public, the value had already dropped to something more reasonable, 7.2 billion. Its value as of early today, half that, 3.6 billion. This is still a brand company. They still own astonishing real estate all across the United States. And remember, WeWork is benefiting from the remote work trend because instead of companies buying blockbuster downtown, corporate headquarters, they're basically letting their employees work out of the nearest WeWork location. So don't count this company out just because they've made mistakes in the past. One, 3 years ago, people thought they were worth 47 billion. Today, you can buy their stock for 3.6. I think that's a bargain. Matterport. Now, this company is one of my favorite picks. I mean, this is a true success story. They are a 3D mapping company, so they have apps on the App Store. They've got groundbreaking technology. They've got a very strong brand. Everyone knows who Matterport is that needs to use this product. And take a look at their valuation today. It's a billion. Original valuation, 4 billion. They're down 75%. Before this webinar started, I was, just kidding with Anna. I was saying, I feel like, when I was in Marrakesh, a couple months ago, a couple of weeks ago, sorry, I went to this market and everything in the market looked like a bargain compared to what I'm used to. Everything in Proptech looks like a bargain. So these are three that you might want to research. Once again, I'm not an investment advisor, but take a look at these three. I picked them for a variety of reasons. I did research. Now, if these don't catch your fancy, here's a few others. Hopefully you've got your pen and you're writing, right? In my mind, even better than Matterport, which is on the top right, is Procore. Remember, I introduced you to Procore early in this webinar. They have an awesome construction management cloud-based software that I'm a client of for my projects. These guys are down 60% from their 52-week peak. I mean, this is a company with hundreds of millions of revenue each quarter. So I think that could be a terrific bargain. I think they're just getting dragged down with some of these deadbeat prop tech companies that were not worth it. And so their stock is also getting dragged down, but they're a successful company. Why should their stock drop 60%? So I think there's some value there in Procore, Procore. There's a few others that are more speculative. Some of you like 10x or 100x, 10 bangers or 100 bangers. Well, you might want to look at Compass and Open Door. So in the first slide, when I introduced PropTech and gave you the definition, I mentioned Compass, I mentioned Open Door. I think these are two very interesting companies. They've got great models, and they are, some of those companies that went public through SPACs, and then the values basically fallen to pennies on the dollar. So will they go out of business? Possibly. But I think that both of them have great brand value and could end up surviving. So you might want to spread a few pennies on Compass and Open Door. They're speculative, but you just never know. Bottom line, if you're interested, this is a great time to look at prop tech. Values went up, great companies were created, shitty companies were created. Now valuations are down to what I consider to be absolutely shocking levels. There is no way that Matterport should be worth $1 billion. This company is probably worth $10 billion, but the entire market is dragging it down. So take a look at this. Nothing that I sell, but I'm very excited about this. As you can imagine, I'm putting some of my money towards some of these companies, and I hope that you look at them as well for investment. But don't forget, of all primary markets, whether it's stocks, bonds, prop tech, fintech, there's one market that hasn't dropped, and that's traditional real estate. So I hope that you'll also consider investing in traditional real estate. Once again, Anna will post the links to these two projects that we have open, and we'd love to talk with you about them, and we'd love to take your questions about prop tech now. Over to you, Anna.
Awesome, Neil.
That was
Yes,
fun,
I
right?
definitely, yes, that was really fun. I was definitely taking some notes. So we have our first question from Steve. What's your thoughts on the impact of MBS quantitative tightening, QT, on the overall real estate market?
Well, I think so. This is obviously not a prop tech question. You're asking about quantitative tightening. I think that the impact is significant. A lot of people are just looking at interest rates, but the Fed is gut punching the economy, and they're punching it twice. One punch is very public, that's interest rate hikes. The other punch is equally strong, but it's not visible, and that is they stop buying real estate bonds. And as they stop buying those real estate bonds, there's less buyers in the marketplace, basically, which drives the price of those bonds down. What are these bonds? Well, they're mostly mortgages, right? So, Wells Fargo basically will create 10,000 mortgages. They'll wrap them up into a nice, package, then they'll put a ribbon on it. And previously, the government, basically, the Federal Reserve was buying these bonds. Now, private buyers have to buy them, and they usually buy them at a lower price. So that also drives up, prices, interest rates in a different way. So the truth is, it's not some separate impact. You're already seeing it in the prices, right? So and prices are going up wildly. So 1 year ago, interest rates were 2.98%, and then they went up to 5.75%. Then they dropped very quickly to 5.3%. And since yesterday, they're back up to 5.48%. Why? Because yesterday we learned inflation isn't going down, it's going up, which means more quantitative, pullback from the Fed and more interest rate hikes. So the impact will be pretty significant. Now you might say, well, you're not really giving me the sort of numbers that I'm used to getting from you. And the answer is you're in the wrong webinar. On our website is the impact of interest rate hikes on real estate webinar. It's on multifamilyu.com. It's 40 minutes long. It's very specific and gives you very detailed predictions on single family, multifamily, cap rates, inflation, and our chances of being in a recession. So check that webinar out. We did it about 4 weeks ago.
So just adding on to that, Neil, maybe you can just comment on that. If you're saying that real estate may go down, why invest in real estate, especially single family?
Absolutely. Good question, right? So the answer is when I say real estate is going down, the truth is there's no black and no white in life. Everything is a shade of gray. So when I look at every major analyst, these people are all scared because they saw 2008, so that they're not willing to stick their neck out. So they're being much more conservative than they were, 12 years ago. And most of them are saying no major market is going to go down. They believe that real estate is overvalued, but things can be overvalued for decades before they go down. Smaller markets are going to go down. So what you're going to see is you're going to see markets like Boise and Tacoma and a few others go down 10, 15%. But if you're looking at the southwest of the United States, a lot of you guys invest in Florida and Texas, Georgia, Utah,
Arizona.
Arizona, Nevada. They're the only markets that we've seen that actually have a prediction of price declines is Las Vegas and potentially Phoenix. So people are split on Phoenix, and those declines are just 5 to 15%. Now, I want to share one data point with you. And again, we're going away from Proptech on this, but that's okay. Obviously everyone's got this top of mind. In 1982, interest rates, well, mortgage rates were 18%. The Fed had raised interest rates so many times that the mortgage market went to 18%. And you might think there was no one crazy enough in the United States to buy homes at an 18% interest rate. We're at 5.6% today, right? As you can imagine, there was a decline in home prices. How much? 10% for one quarter. Guess what happened the next quarter? 10 down, 10 up. 6 months later, the market was at the same exact price. And the real estate market actually exited the 1982 recession higher than it entered. The real estate market is extraordinarily sticky. What you saw in 2008 was not a decline in the real estate market, it was a lending debacle. We gave loans, we gave $1 million homes to gardeners. That doesn't work. That was a lending debacle. Today, lending standards are very tight, so it's very difficult for home prices to actually go down. So when I'm saying that they might go down, they're selected markets. What I think will happen, and you watch my webinar on this to get the details, is that a year from now, home prices will be up 4%. 4 doesn't sound like a lot given it was 18 in the last 12 months, but please compare that with every other kind of asset in the world. Right now, 0 is an astonishingly good number.
Okay, how does the rise of interest rates have an impact on Proptech companies, if any?
It has a very strong impact. What's happening is a lot of the people that were investing in prop tech companies, both pre-IPO and post-IPO, were actually investing with borrowed money. And this money for the last 2 years has been incredibly cheap. In the trade, we basically say money was free in 2020 and 2021. Money was free. So people borrowed billions and billions and billions of dollars and invested them into these companies speculatively. Obviously, at this point in time, some of those borrowings, the interest rates are spiking. So now those companies are panicking. So they're pulling out. They're not investing anymore. And because these prop tech companies, many of them are not making money, they need more investments. And so what's happening is that they are having to take their $1 billion valuation from last year and mark it down to 400 million to raise new money. So interest rates have a massive and immediate impact on not just prop tech companies, but any tech companies, both pre-IPO and post-IPO.
We have an investor that wants to know your thoughts on the impact of the market on Ugrow.
So significant, but short term. I think that our model is so resilient that we're actually also benefiting. So we expect that construction cost increases that we've budgeted for will now be much lower. We expect that we will have more negotiation power. And we do expect that when we deliver these buildings, interest rates will go down. Once again, if you look at the last 61 years, 9 times the Fed's raised interest rates. 9 times. Sharp up all 9, sharp down. We're going to be delivering product on the sharp down piece, and that's an extraordinary opportunity. So I'm very excited about Ugrow. For those of you that don't know about Ugrow, you're going to find out at some point in the future. So that's currently not something that we advertise publicly and don't have any intention of doing it at this point.
Is there room for other tech startups similar to Service Titan based on the total addressable market? Is there room for more?
So the total addressable market, or TAM, is a key number. I can tell you that Service Titan wouldn't be, I know it's worth less now after the crash, but it wouldn't be worth that much if there wasn't a large TAM. So even though the market was, in my opinion, too bubblish, I think most venture capitalists look at the TAM, or the total addressable market, before they invest. Service Titan is actually a pretty heavy market, because what's happening is contractors, are generally not tech savvy. It's been very hard to get them to use computers, and companies that have tried to do that have all gone out of business. But they seem to be using apps. My contractors are now using Venmo, they're using PayPal, they're using Square, and apps make this kind of technology really easy to use. So what Service Titan is really doing is they're connecting buyers like you that, for example, need a kitchen remodeled with these kinds of contractors, and then they're making the contractors' workflow very efficient. So I think that's a very large market. I would say that there's probably, I mean, they've got 100,000 contractors on their platform now, but even when I look at the small to mid-size market, which is where they're focused on, there must be several million vendors. So I think they're probably at 10% of their TAM, or as addressable market.
Can smart contracts improve on asset management, title and escrow, ongoing accounting, fractional interest, and liquidity pooling?
I think those are many different questions, right? So I can't say yeah. I can say yes, they can, but obviously that wouldn't give you a useful answer. Liquidity pooling is a very advanced concept, so we'll stay away from that. What I'm seeing is smart contracts are, they started off in a very simple way with DocuSign. So everybody knows DocuSign, so that's obviously a tech company. They're also a Proptech, by the way, because a huge percentage of DocuSign's customers are in real estate. But now we're seeing it evolve. Now we're seeing companies go from just a straightforward signature to very specific companies being built in certain verticals. And that's what I'm really excited about. And I think that workflow in those particular markets can improve. So I won't give you an example now because it'll take me a little while, but I'm excited about, smart contracts basically being applied in interesting ways. For the moment, their application on the blockchain seems to have stopped, because the crypto market has been so badly decimated that nobody wants to be connected to blockchain anymore. So I think most of those startups are pretty much in pause mode.
Sue says she's been reading that rents are continuing to increase due to potential homeowners opting out of buying due to increasing mortgage rates, and they're renting instead. So is Grow Capitus seeing continuing robust rent increases and low vacancies on our projects as well?
Yes and yes. So June data just came out. So we're in mid-July. June data was very strong for rents throughout the U.S. And I'm not I'm not trying to say that my properties are strong. So the market was strong. We saw the same level of strength. So we didn't see anything different from the marketplace. Um, Very strong, and I expect it to stay strong. Keep in mind, with all this talk of recession, all this talk of interest rates, we're at 3.9%. When has the US economy ever gone into recession at 3.9% unemployment? We have to see millions of layoffs. We're beginning to see them. It's normal. They will accelerate, but it takes a long time to get into a recession. And what we see actually is that rents trail during recessions. It takes a while for rents to even be affected. So I don't expect there to be anything except very strong rent growth for the rest of this year. Next year may not be. It might be pretty anemic.
Do you think that real estate firms are able to keep up with the rate of innovation that the prop techs are trying to drive, or are too many prop techs detached from real operational challenges that exist within teams that are on the ground running the day to day?
I think the answer is nuanced, right? You want me to give you a black and white answer. The black and white answer is yes. Prop techs want you to basically go out and completely reinvent your business model because they've only got, 24 months before they go out of business, right? Real companies can't do that. We've got other problems to deal with. But the truth is what is happening is prop techs are not focused on getting 100% of the market in their corner. If they get to 5%, somebody gives them more money so they can get to 10%. And then they can convince, the people to get to 15%. That's how technology works. It's the early adopters that make companies successful. The first 250,000 Tesla cars that were purchased made no logical sense. But the people that bought them understood what Tesla was trying to do. And they understood that at some point they would have access to an ecosystem of 20,000 superchargers. Back then, there weren't even 1,000. Today, all of those people have access to the biggest supercharger network in the US. So that what really happens is you need early adopters. So to take your question away from black and white, I think there's enough people in technology. I'm a great example. Anna's actually an even better example. She loves basically looking at different technological options to optimize her team. There's enough adopters so that either the company breaks even or their investors see that there's potential here and they give them more money.
Do you foresee prop tech companies being created that allow people to purchase or sell homes using crypto?
Well, yeah, that's already happening. We were starting to see that in the second half of last year. So there's at least two or three that were allowing that. That has very quickly stopped. I mean, the volatility of crypto is so immense that at this point, those companies are pivoting and trying to do other things. They're trying to do lending. Um, the problem is crypto is so volatile, even in a regular market, that it becomes very, very difficult to create these business models. Because just as you're doing okay, the market crashes and now nobody wants to talk to you.
Yeah.
So it's I don't know how to solve this particular problem, but I just don't see these companies being successful because of volatility.
Any thoughts on mortgage rate dropping by the end of the year?
No, I don't think so, because I think that the Fed will hit its peak by the end of the year. And then the question is, how far will that take the US economy? If unemployment is at 6% by the end of the year, which is pretty unlikely, by the way. And by the way, there's a poll up on the screen. We love it if you could put information in here so we're not bothering you. If you're not interested, please fill out the poll. So to answer the question, if unemployment is close to 6% by the end of the year, you could start to see mortgage rates drop. It's very important to understand this. The Federal Reserve does not set mortgage rates. They set an internal rate. They call it the Fed funds rate. It influences mortgage rates. So they set something, and now that they've set it, the market says, what should I set my rates at, right? So the mortgage buyers basically get influenced by that rate. So what happens though is the mortgage market usually moves several months, 3, 4, 5, 6 months ahead of the Fed. So as the Fed starts making grumbling noises about increasing interest rates, the market already increases them, right? So for example, today the Fed's only increased interest rates by about 1.5% from where they were last year. Well, the mortgage markets is up 2.6%, so they're running ahead of them. So by the end of the year, if unemployment is at 6%, the Fed will make grumbling noises about, I think we're done with our raises. I think we're fine. We're going to take a pause now and watch the market. We're seeing unemployment rise. We're seeing the economy, slow down. Well, that's usually a indication for mortgage companies to say, oh, well, I think rates are going to go down. So they start to trend them downwards. It's really all about unemployment, right? So watch the unemployment number. I can tell you rates are not going to go down or even plateau unless unemployment rises because inflation is far too high. So the Fed has to keep pounding the economy, beating the crap out of the economy until unemployment rises. And I know this sounds stupid because you're like, really, the Fed's job is to create unemployment? Yes, right now, the Fed's job is to create unemployment. There's no other way to slow the economy.
Since you mentioned 3D printing earlier, Neil, Keith has to ask if you've heard of this stock, DM, for desktop metal. He thinks it's a sleeping giant.
Well, I'll take that as a research stock. So I haven't heard of desktop metal. So I'll research that one and maybe we can mention it in a future webinar in the Proptech version 2 webinar next year. Desktop metal. Thank you.
Desktop metal. Regarding inflation, are you seeing increased or lower prices on construction building supplies right now?
Increase. I mean, obviously, inflation's at 9%, so that's going to affect the construction market. So we're padding and then padding our padding because we don't quite know, when it stops. Now, on the labor side of the construction market, we are now beginning to see early signs of weakness because what we're seeing is that our projects at this point are funded, right? So but most projects are in some stage of funding, and a lot of those projects the developers are backing off on because they were too early in that process and it didn't work out for them. So their window of opportunity is gone now. So all of a sudden, builders are like, well, I might not get enough work. So I think that the labor market is beginning to soften. I am not seeing any evidence yet of the material market for new construction softening. I hope it happens.
What do you think about prop tech companies replacing real estate agents? It sounds like it should be possible, but haven't seen any successful companies doing that other than Redfin agents, et cetera, doing so partially.
I think it's a process. So replacing real estate agents is not an easy process. In my mind, it requires a generation. Millennials are perfectly fine with using apps to go out and check out homes that they want to buy. It seems Gen X is not. And Gen X has gotten a lot done. I mean, they're pretty good with technology, but they're not fully comfortable. They're not as comfortable as millennials. The peak years for millennials to buy homes are starting now. So you're going to start seeing more, app type models like Redfin and Opendoor and Roofstock take hold every year. I feel like it's taking forever for real estate agents to be replaced. And I apologize to any real estate agents on the call, but I think that you guys charge too much for your service. And in today's technology world, you are an antique. It just takes a while for technology to catch up with you. It's inevitable, though. I just don't find it compelling for real estate agents to be charging 6% or 5%, for on both sides of the transaction. I think those numbers make no sense in today's world. So it's only a matter of time. When it'll happen, I don't know. It's not an easy thing to replace real estate agents, so it's taking technology time to do.
What are your thoughts on land, unimproved land, specifically values, the value of unimproved land?
So when interest rates go up, unimproved land values fall very fast. It's improved land, real estate that tends not to fall, right? Unless the market again goes down a lot. But land tends to be a leading indicator. So if you're buying land right now, if and you can wait, it's going to go down. There's no way I think land prices that are prevalent today hold. I see no way. I mean, if I expect unemployment to go up to 6% by the end of the year, I can't possibly imagine people charging what they're charging today for land.
Of all the prop tech businesses you've referenced, what do you see as the most robust and promising?
I think disruptive models, right? What Pacaso is doing is truly disruptive. Rich people will buy second homes, right? They buy second homes for 6 million. They also buy second homes for 60 millions. If you give them a better way to buy more of these homes, right? They will buy them. That's why I think Picasso is so disruptive. You're giving a rich dude who has $8 million to spend a way to buy 6 or 7 luxury homes that someone else is managing for them. And they can even sell those shares once those homes go up in value, right? Of course, earning Picasso yet another fee. So I think disruptive models are very key. We believe that our company, You Grow, is a disruptive model. We're not ready to tell you the story. We've told a very, very small subset of our investors that story. So we'll share another disruptive model with you later in this year.
Okay, last question. Do you think agricultural orchard land will go down in California?
So from a cycle perspective, the answer is absolutely. So in a short term, agricultural land has to go down as other kinds of land goes down. Remember, land's a leading indicator. As the market slows, land tends to slow much faster than any other kind of real estate. So the answer is yes. Keep in mind, though, I am a very strong believer that agricultural land in the US is overall undervalued for a wide variety of reasons. So I'm a follower of the Bill Gates, um, school of thought on agricultural land pricing. As you know, Bill Gates is one of the biggest landowners in the US. He owns a massive amount of this land. And if I wasn't busy buying improved lands that I'm building buildings on, I would certainly look at buying this land. I wouldn't buy it in California. California is overvalued, but Montana, take a look at that. I think that those are great places to buy land. I wouldn't buy it now. Once again, prices are about to decline. But overall, I think looking at it from a 5 to 10 year time frame, there's no way agricultural land in the US is priced correctly. It's definitely undervalued.
Last question, Neil. Can you talk about
Last.
the pain of finding and underwriting property fast and the available tech out there available for this task?
So obviously, underwriting is a very, very difficult process. I don't believe that any technology options have completely gotten to the point where they can address this. The truth is, the only company that is in the position to create an appropriate technology is called CoStar. And I think there are many companies out there that are doing pieces of it that CoStar basically needs to buy. Now they are acquisitive. They bought, who did they buy? They bought
Who
LoopNet,
haven't they bought?
right?
Who
So
haven't they bought,
yeah,
Neil?
right, that's right. They keep buying companies, right? So I think that the eventual automated underwriting solution, it can only come from CoStar because I am not aware of any other company that has the data to automate or semi-automate underwriting. So I'm waiting for their solution. Don't expect it to be cheap.
Yeah, that's right. All right, we've got it. We've got it done.
Awesome. Well, thank you, everyone. I hope this was fun. This was really one of our thought. Every once in a while, we do webinars to provoke people's thoughts, to make you really think about real estate a different way. PropTech's obviously a completely different segment from what we do, but it's our job to kind of open your minds to this. Hope you enjoyed this. I want to thank my co-host Anna Myers and thank everyone for attending. Have a wonderful rest of your evening.
Thanks,
Goodbye.
everybody. Bye bye.